There's a strategy so simple that professional investors almost feel embarrassed to talk about it. No charts, no predictions, no staring at screens at 3 in the morning. And yet, over the last 7 years, it quietly outperformed the people who do all of those things. It's called dollar cost averaging. And by the end of this video, you'll understand it better than most people who've been investing for a decade. Let's get into it. First, what it actually is. Dollar cost averaging means investing a fixed amount of money on a fixed schedule, no matter what the market is doing. $50 every Monday, $500 on the first of every month. The amount doesn't matter, the consistency does. Here's the part that makes it powerful. When prices are high, your fixed amount buys fewer shares. When prices crash, that same amount buys more. You're automatically buying less at the top and more at the bottom, without thinking, without timing, without emotion. Let me show you the math, because this is where it clicks. Say you invest $500 a month into an index fund. Month 1, the price is $50 a share. You get 10 shares. Month 2, the market drops. Price is $40. Your $500 now buys 12.5 shares. Month 3, it recovers to $55. You get 9 shares. After 3 months, you've invested $1,500 and you own around 31.5 shares. Your average cost per share? About $47. But the price at the end was $55. You're already ahead. Not because you predicted anything, but because the system forced you to buy more when things were cheap. That's the entire trick. Now, here's where most videos lie to you. They tell you dollar cost averaging always wins. It doesn't, and I'm going to show you the real data. In 2012, Vanguard ran one of the most cited studies on this. They analyzed markets in the US, the UK, and Australia across rolling 10-year periods, going all the way back to 1926. The result? Lump sum investing, meaning putting all your money in at once, beat dollar cost averaging about 68% of the time. Read that again. Investing everything immediately won 2 out of 3 times. The reason is simple. Markets go up more often than they go down. The S&P 500 has had positive returns in roughly 73% of all years since 1928. So the longer your money sits on the sidelines, waiting to be invested, the more growth you miss. On average, lump sum beat DCA by about 2.3% over the period studied. And on a $100,000 investment, that adds up. Vanguard's numbers showed that $100,000 put into the S&P 500 at the start of 2010 grew to about $356,000 by the end of 2019. The SOST amount spread across 12 months? About $334,000, a difference of over $20,000 just from timing. So if the data says lump sum wins, why does everyone still use dollar cost averaging? 3 reasons, and they're more important than the math. Reason 1. Most people don't have a lump sum. This is the part the studies skip over. The Vanguard comparison assumes you have a big pile of cash sitting there, ready to invest. But that's not how most people live. Most people invest from their paycheck, a little every month, which means dollar cost averaging isn't a choice they make. It's the only structure that fits their life. If you contribute to a retirement account from every paycheck, you are already doing dollar cost averaging. You probably have been for years without calling it that. Reason 2. It removes the single most expensive thing in investing: emotion. Here's a fact that should stop you. The biggest losses in investing don't come from bad assets. They come from good investors making emotional decisions at the worst possible moment. When markets crash, fear takes over. People sell at the bottom. When markets soar, greed takes over. People buy at the top. Buy high, sell low. The exact opposite of what works. And it happens to smart people constantly. Dollar cost averaging removes that decision entirely. You're buying on schedule, no matter how you feel. When everyone else is panicking and selling, your automatic purchase is quietly buying the dip for you. Academic research backs this. Studies in behavioral finance show that DCA reduces what's called regret and loss aversion. The pain of losing money feels about twice as strong as the pleasure of gaining it. DCA protects you from yourself. And for most people, That protection is worth more than a few percentage points of theoretical return. Reason 3, and this is the most underrated one. Volatility stops being scary. It becomes useful. If you invest a lump sum and the market drops 30%, that's a disaster. Your money is down, and you just have to wait and hope. But if you're dollar cost averaging, a crash is the best thing that can happen to you. Lower prices mean your fixed amount buys more shares. You're accumulating aggressively, exactly when everyone else is too afraid to buy. Let me prove it with the most extreme example I can find. Crypto. Bitcoin is the most volatile major asset on Earth, which makes it the perfect stress test. Data going back to 2018 shows something remarkable. Someone who simply bought a fixed dollar amount of Bitcoin every single week from 2018 through early 2026 would have seen returns of around 1,100%. And here's the key. That period included two brutal crashes, the COVID crash of 2020 and the Terra and FTX collapse of 2022, where Bitcoin fell from around 69,000 to under 16,000. The DCA investor didn't need to survive those crashes by being smart. They survived by being consistent. During the 2022 crash specifically, investors who kept buying through the fear ended up with an average entry price around $35,000, far below where the price eventually recovered to. There's even data on a modified version, a fear-based DCA, where you buy more when markets are in extreme fear. Over that same 7-year window, that approach returned around 1,145%, beating simple buy and hold by almost 100 percentage points. But, and this is critical, DCA does not work on everything. The same data showed something important. If you had started dollar cost averaging into Ethereum at its all-time high and held through a long underperformance period, you'd still be at a loss. Even with cost averaging working in your favor. DCA is not magic. It smooths your entry. It does not turn a bad asset into a good one. Dollar cost averaging into a dying altcoin or a meme coin isn't investing. It's gambling on a schedule. The strategy only works if the underlying asset trends upward over the long term. Quality matters more than the technique. So let's put this all together into something you can actually use. Here's the honest framework. If you have a large lump sum available and you can handle the emotional risk, the data says invest it immediately. Time in the market beats timing the market. If you're investing from your income, month after month, you're already dollar cost averaging, and that's exactly right. Don't overthink it. If volatility makes you panic and you know you might sell at the worst time, then DCA isn't the mathematically optimal choice, but it might be the one that actually keeps you invested. And an imperfect strategy you stick with beats a perfect one you abandon. And here are the mistakes to avoid. Mistake 1. Stopping during a crash. This is when DCA does its best work. Pausing during fear defeats the entire purpose. Mistake 2. Judging it too early. The data shows the average 90-day return after a fear period is just 2.4%. If you check your portfolio weekly and panic, you'll quit before it pays off. Think in years, not weeks. Mistake 3. DCA into the wrong asset. A broad index fund has a century of upward history behind it. A random altcoin does not. Choose what you average into carefully. Here's the bottom line. Dollar cost averaging won't make you the highest returns on paper. Lump sum usually wins that race. But investing isn't a math problem on paper. It's a behavior you have to repeat for decades, through fear, through crashes, through boredom. And a strategy that keeps you consistent, removes emotion, and turns volatility into an advantage beats the theoretically perfect strategy that you abandon the first time the market scares you. The best investors aren't the ones who predict the market. They're the ones who never stop showing up. That's the shift. Consistency over prediction. If this made the concept click for you, you know what to do. This is Shift Ahead, and now you're ahead of the curve.